Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Pete Wargent, welcome back to the Australian Investors Podcast, mate.
Pleasure. Thanks, Owen. It's great to be here. Great to be on.
Yeah, we've spoken a few times. We spoke many years ago, and then we spoke at the beginning of COVID. We talked about property and what the data was showing us then. And at that time, things were pretty gloomy for pandemic reasons. And now it's kind of inflation and interest rates are on the horizon, and people are, again, kind of scared and fearful about what that might mean. So we're going to dive into that. This is a bit of a medley of sorts because we're going to talk about a business that you've co-founded recently. We're going to talk about, your journey, how things have changed through time, and maybe tackle some of these topical things like what's going on with property, also in the economy with rates and inflation. I thought maybe we could start off, mate, with a bit of quick-fire Q&A, 3 short questions. You can answer these as quick as you like. I don't know how we're going to do this. I'm just going to throw them over to you and see how you go.
Whatever works for you.
Okay. So first one is, where do you think inflation and interest rates will end 2022?
In Australia, I think headline inflation could get to 6% by the end of the calendar year. I think if you looked at the underlying measures of inflation, maybe 4.5%. So that means interest rates are going up for sure. Fixed mortgage rates have been rising for a long time anyway. I think at the end of the year, the cash rate might be 1.5%, maybe 2% maximum. And I think for this cycle, terminal cash rate, 2.5%.
Yeah, right. Okay. So when you say this cycle, do you see inflation therefore being more transitory, or do you think this is something that's going to be with us for a while?
Yeah, look, a lot can change quickly in geopolitics. And you have to remember, it's only in September and even early October when people were calling for the inflation target to be reduced because to 1% to 3%, because we couldn't reach the 2% inflation target. Sure. So a lot can change quickly. I think overall, all of those things that were putting downward pressure on inflation, like outsourcing of work to Asia and the global increase in the supply of the labor force and technology, all of those things, casual workforce, all of those things haven't really gone away. It's just that we had a supply shock overlapped by another supply shock. So we've got China in lockdown, we've got Ukraine warfare ongoing, and this is all coming on the back of 2 years of COVID disruption. I suspect that inflation is transitory, but the way things have been going in Ukraine, it might stick around a bit longer than we were first thinking.
Yeah. Okay. Interesting. We'll dig more into that towards the back end of the conversation because we'll talk about asset classes. Another quick fire question. Have you ever traded Bitcoin or Ethereum? Why not?
No, I'll tell you an interesting anecdote. I presented at an event at the Gold Coast a couple of months ago. And at the end of the presentation, you got to sit in these little tables of 10, and everyone in the group would ask you a question. And every single group I went round to, the young people were saying, so what do you think about crypto? And this is, from a sample of 100 people. And the question was coming up a lot. I guess the thing is, if I was 20 years old, yeah, for sure, I would be probably using leverage. I'll probably be punting on Ethereum or, whatever the latest fad is, in the same way that I used to be very into the penny stocks and mining stocks when I was younger. I guess the thing is, I'm 45. I've had some good results from investing and a bit of luck along the way. So really, I'm thinking these days of rule number 1, don't lose money, because I know that if I don't do anything stupid, don't get divorced, then I'm on track for a fairly comfortable retirement. But for sure, if I was 20 years old, I may well think differently.
Yeah, because we caught up in Noosa last week and we talked about this, and we talked about basically everything that's going on in the world of cryptocurrencies and Web3. And well, since then, there's been a lot that's hit the news. And we talked off air just briefly about not making any enemies. So I thought I'd just bring that up. But people may remember that we've spoken in the past before. And the first conversation was more about your journey through, I guess, the early part of your career and being an accountant, going on this journey to, I guess, kind of clean up your personal finances and really fast track your wealth creation. I know you met your partner and she instilled some kind of values on you as well when it comes to investing and money in general. But if I'm not mistaken, Pete, you could self-fund your lifestyle basically by the age of 33. And one of the questions that I think come from that is, what maybe is one thing that moved you towards that goal quickly that you can look back on it in retrospect and think, oh, that was really effective at the time? And what was maybe one thing that pulled you away from that goal of generating that type of wealth? Because people hear 33 years of age and they think, wow, that's young. You must have been a miser or really, really, hyper effective at saving or had a massive income or something. And I doubt that's the case.
Yeah, look, we were both higher income taxpayers, me and my wife, by the age of 26. So obviously that helps.
Mm-hmm.
But yeah, as you mentioned, you've got two different things there. There's pull factors and push factors. For me, the biggest thing by far that drew me onto that path was I just couldn't stand the corporate job. I did it. I graduated. I did what I was expected to do. Qualified as a chartered accountant. Went through the system at Deloitte. Manager, senior manager, director. Then I went into doing the sort of going into industry, and I was a group FC in the listed environment. I was like, I seriously cannot do this for another 32 years. I met a guy who Stephen Moriarty, a few years back, and he told me about this concept of the Enneagram assessment. And it's a really useful conceptual framework if you're not familiar with it, just to understand your personality type and what are your motivations. And for my personality type, freedom, no constraints, not having a boss telling you what to do. So for me, that was a huge factor. I was just couldn't physically conceptualize sitting in an office for the next 35 years and through to retirement. So that was a big factor that pushed me towards it. Now, it's not to say that it's not for everyone. Some personality types are very driven by goal setting, achievement, status, high-powered corporate role, or being a CEO or whatever. But that's a different personality type from me. So that's really the thing that sort of was the big driving factor. We were both higher income earners, which obviously helped. And I guess, we just basically sat down, and it's pretty sad, but we wrote a high level plan. We had the dream board. We had a target of, and for us, it was, we used a lot of leverage in property, which again is not for everybody, but it was what we consider the fastest route out of the rat race for us. And also I was a bit of a party animal when I was younger, but we gave all that up, quit drinking, ran the Sydney Marathon, stopped spending money. So we really went at it very hard, which, again, different for different people. But for me, I found that not going to the opera bar on Friday nights, that was more or less an impossibility for me, but we did eventually manage to get into that routine. But yeah, again, it's a different journey for everybody, and you've got to find a way that works for you.
Yeah, I think you talked about that the personality types are so important. A lot of people don't think about those. They just think about it as a spreadsheet, right? This is what I should be saving. This is what I should be earning. This is what I should invest. But that doesn't always take into account how you feel and how you behave with money and how you behave in life. And but one of the things that really struck me about your journey when I was reading your books is basically you went through that period, like you said, where you did a lot of partying and had a really good life and went to the opera bar. And then you kind of switched gears really quickly, which I thought was really impressive to go from one extreme to the other. Not everyone could probably do that. Anyway, I thought that was really interesting. So, and one of the things that leads on the back of this is how then has your investment strategy changed or morphed from then, say when you were aggressively saving, accumulating assets, to now? Have you done anything that's drastically different? You said rule number one is don't lose money. How has that kind of played out in your personal investment profile and strategy?
Yeah, well, a couple of different things. So yes, going from living in nice places with harbour views, traveling a lot, partying Friday, Saturday, Sunday. You're right. Going from one extreme to the other is quite difficult. One of the things for me is I just reached the point where I just basically I was never a good drinker. I don't normally talk about this, but I'll talk about it with you, Owen, because you're a good guy. I was like a lot of young poms. I was a heavy drinker, but I just got to a point. I just thought this is not doing me any favors, and in the end, I just thought I'm just going to stop. So I went completely cold turkey. The problem is for anyone who and anyone who's been through the same thing would know what I'm talking about. When you take away something that's such a big part of your life, you've got to fill it with something else, because it leaves a big hole in your life where you used to be going out Friday, Saturday, Sunday, probably Thursday, Pitchy Bay Hotel. If you're not doing that, you've suddenly got to replace it with something else. Now, for me, I found an interest in personal finance, investing, travel, learning languages. But again, whatever it is different for different people. I guess since we quit the corporate role and went out and we've been doing our own thing, and you'll have been through this yourself as a startup business owner or a small business owner, it becomes much harder to be a borrower. So you can still do it, but you've got to jump over more hurdles. So we've still added properties to the portfolio over time. We've diversified a bit more. These days, we've got farmland and commercial property in the property portfolio. We still do stocks. So I guess the strategy hasn't changed, but we don't use big gearing these days. That's the main difference. When I was young, we just borrowed whatever we could. These days, it would be much harder to do that, even if we wanted to, but much more modest loan-to-value ratio and leverage these days.
So you recognize that you have very stable, high incomes at the time, and that is like the ideal scenario for banks, right? For lenders, because you two incomes, really solid, good savings rate, can leverage as much as you like, and then it comes down to asset quality, right? What are you buying? When we spoke last week, you reminded me of something that you live in Noosa, but a lot of your investments are outside of that. They're in Sydney and, like you said, farmland. And if I'm not mistaken, you still have an investment overseas. Is that correct?
Yeah, well, half of our portfolio is in England. Yeah, so we spend a fair chunk of the year in Europe. So as you mentioned, when we were younger, we largely went into London and Sydney property. That was, I guess, the two markets that we went really hard into when we were younger. As we get older, we don't have the same leverage or appetite for risk these days. So we're generally buying cheaper assets when we do property. And also, these days we just look for markets that are undervalued. I'm trying to think of an example. Like after the global financial crisis, a lot of markets in the UK got smashed, down 40%. So he's kind of using that margin of safety approach, buying stuff that's cheap. Geelong in 2014 was another one. Yeah,
you mentioned that. Yeah.
Everyone was saying, last one out, switch off the lights when they were closing the car factories, and there were a number of big high-profile closures in Geelong. But I was thinking, well, is this really a long-term thing, or is it, is this just a short-term disruption? So yeah, but much cheaper assets these days. When we were starting out, we were mainly investing in places like, Bondi and Darling Harbour and the inner west of Sydney and stuff. These days, much sort of less leverage.
Just on that, because we did talk briefly about this last week, because when you invested in Geelong, you kind of said, like, you look for things when there's like bloodies in the streets, so to speak. Like the headlines are just all doomsays, just calling for declines, and this is, it's going to get worse before it gets better, type of thing. How did you get conviction that even with like the Ford factory closing here in Victoria and Geelong, how did you get conviction to back yourself into that position? Like, was there something that you looked at in particular that said, okay, I'm confident with this? Did you travel to the area? Like, what did you do?
Oh, really? I was advised by a buyer's agent called Catherine Cashmore, who's a good friend of mine. But also the yields were really good. You could buy the gross yields on residential property were 6-7% in some cases.
Oh, wow. Okay.
When at a time when mortgage rates were falling. So that was a part of it. But look, it's the same. I mean, how do you hold your nose and buy stocks that have been battered down? It's the same way, right? You just think, particularly with an ETF, if you're buying a country or a sector, it's fallen in half, you know the headlines are not going to be good, but you just hold your nose and do it anyway. And I guess the other thing is, if you're taking a long-term view, then that kind of sort of takes the stress out of the equation. If you're worried about what's going to happen in the next 3 months, then yeah, it could be tough. So yeah, it's the same principle really, and you can apply those same principles in the stock market as well. But I guess if you're going to do it, you have to learn to kind of ignore the media headlines, because almost by definition they're going to be negative. I'll give you actually just thought of another example. A few years back, all these media headlines started talking about ground zero for Australian properties, apartments in Brisbane, and I was living in Queensland, and I thought, well, all the headlines are saying it's the end of the world. There must be some bargains there. And we bought a place in New Farm, which is blue chip area, nice little unit with views in district views in 2 directions, and it was a dump of a unit and needed a full renovation. But I guess the same principle, right? If the media is saying the world is ending, that probably means you're going to buy something under market value. And I'm guessing that when you bought your first home, it was the same thing. The media was, prices are going to fall 35%, and vendors are quite keen to offload. Well, that's ideal for you as a buyer.
Yeah, for sure. We bought our place the first day of lockdown, stage 4 lockdowns in Victoria. So that played to our favour. I'd like to switch gears now, mate. I realised we never spoke about your book, Wealthways for the Young, which is a book that you wrote, designed for children, for parents. There it is. Yep, got it in front of you.
I even grabbed a copy off the bookshelf. There you go.
There you go. Wonderful. And it talks about, how you can teach your children about money, some things that you can do with them, and as they get older too. So I was hoping maybe, because you've got kids as well, I'm hoping you can tell us, at the beginning of the book, there's this section where you talk about, most people don't want to read a book these days. And at the start, you give us these kind of 20 things your kids should do. Maybe you can share. It's on page 12. Maybe you can share a couple of them with us, and maybe on the back of that too, how you've gone about teaching your kids about money or investing.
Right. So that was the driver for me writing the book, because we decided to have kids, and I'd heard all of this stuff like, you shouldn't tell your kids this and you shouldn't do that, and I was like, well, that's all well and good, and a bit like yourself, I guess when I was growing up, there wasn't really a healthy relationship with money in our family. So I thought, well, let's do some research, and I'll try to write a book about what you should teach your kids about money, but bring it into the modern context. So I guess some of the simple things are the same as what we were sort of told or heard about when we were younger, and that is, teach a concept these kids of like, save a third, and watch the interest grow, spend a third of your money mindfully, and donate a third to a good cause. Like our kids like wildlife warriors at Australia Zoo, so they go 1/3 of the pocket money goes there, a third of it you get to spend in the toy shop or buy lollies, and then a third you put aside and save for a rainy day, and they can learn about compound interest. So, that is not a new idea. That idea has been around for decades. So that's an example of something you can do that's a very traditional step. But as I said, I put the 20 bullet points right at the beginning, because I know most people are not going to sit and read a book these days. But as I said, if you follow those 20 simple bullet points, your kids will be better off financially than 98% of the population, because most people don't know the basics. I guess another simple thing is giving your kids the opportunity to double their pocket money by doing household chores. So my kids wash and vacuum the car, and they can double their pocket money each week. So those are really traditional ideas. I think the thing that's changed a bit, I guess these days, we already mentioned cryptocurrencies and cashless economy. So simple things like, teaching your kids to use cash, and also teaching them good online habits, because, I guess that's something that we didn't have to contend with growing up. But for our kids, they want a phone already, and they're like 5 and 7, so there's new things coming onto the horizon. I guess most importantly, try and get them to avoid at all costs consumer debt, because most people don't, and it's a massive, it's compounding in reverse, as you know.
Okay, so how do you find that the kids respond to that? Do you think that they react differently? Like if you ask them to clean the car, does one think, oh, yeah, okay, I'll do it, and the other one thinks no? Or like, do you try and prompt them in any way? And have you found certain things more effective for one over the other?
My daughter Rue, she's 7, so she gets it. She actually always, does the car need washing again? She wants to double her pocket money every 3 days, right? So it's like compound interest on the pocket money. My son Stan, he's only 5, and he's a bit of a lazy bugger, so he needs a bit more of a push. But that might just be an age thing,
Yeah.
But as you know, like everybody, has different sort of personalities and relationships with money. But one of the things that sort of got me interested in this was, I think, as I mentioned on your podcast, maybe last time we were on, that concept of give me the boy of 7 and I will show you the man. And there was research done decades ago that a lot of the learning, and I don't understand the science behind it, but because of the way that kids develop, a huge amount of their development is done by the age of 7. So if you set them off with bad habits, it's going to be harder to correct them down the track.
Yeah, it's fantastic, and you can see it playing out. Like at the moment, I feel like that osmosis is really at work too, right? If they see your habits, they're going to soak that up like a sponge. So that's fantastic. If you want a copy of the book, Wealth Waves for the Young, we'll put show notes in, put it in the show notes so you can see and find a copy for yourself. The next thing, and we're jumping around a bit, but I like this, is basically I want to pick your brains on a startup that you and Doron have come together to create. It's called BuyersBuyers, and I'm hoping maybe you can tell us, how did this come together? How did you meet Doron? Why did you come up with this idea of a platform for buyers advocacy? And I think maybe some context will help here. Like, what role do buyers advocates play? And then we'll just riff from there on some of the things that have transpired.
Yeah, so interesting, because I've been doing my own thing for about 12 years, quite happy, designing my day, only really doing the stuff I want to do. A bit like yourself with Rask, you try and do the stuff that you enjoy because it feels like it's not work. Anyway, a few years ago, I did some work with a guy called Doron Peleg, who had a startup called Riskwise Property Research. And we did a report on negative gearing that actually ended up going to Treasury. And we've done a few bits and pieces like that. Anyway, about 2.5 years ago, he came to me and said, got an idea for a startup, a bit like how in the mortgage broking space, there used to be, say, 5% of loans went through brokers, but then along came Aussie Home Loans and AFG and Connective and all of the aggregators. And these days it's like 70% go through mortgage brokers. So, but we need to do the same thing, but for property buying services. So predominantly buyer's agent services, but also all the other parts of the process that hang off that. And I thought about it, and it's a difficult decision, having done your own thing for over a decade, to then go into a startup, which can be all encompassing, as you know from experience. So I put in some seed capital, and we're building Australia's only marketplace, I guess, for seamless end-to-end property buying and residential lending solutions. So just to improve the consumer experience for buying property. So I guess the problem we were solving is that something like 18% of property buyers consider using a buyer's agent, but today it's only about 3% of the market actually does use buyer's agents, largely because of the cost. It's Sydney or Melbourne, you might pay $20,000 to $40,000 for a buyer's agent, and most, particularly first-time buyers, just won't pay that. So we developed an affordable marketplace solution. So we've got 3 products. We've got a property plan called WePlan. So for people who don't know what to do next, we've got a planning solution. We've got the traditional end-to-end property buyer's agent solution, but we also have a cheaper alternative called WeBuy, which is effectively due diligence, negotiation, and acquisition through to settlement. It's not a full end-to-end service, and it's therefore much more affordable. So anyway, long story short, we launched our B2C marketing campaign in September last year. We got up to a run rate of over 2.5 million within 5 months. And we're getting a fair number of inquiries each month for home loans as well. So we do offer in-house broking services. And so I guess we've reached the point of Series A funding round, raising 3.5 equity or convertible notes. We raised a fair chunk off our own back, but now we're going to go to family offices and institutions as well, and professional investors. So I guess that's it. That was how it came about, and that's where we've got to.
So you're basically, if I could summarize, you're basically connecting in the first instance, you're connecting people that want to buy or invest in property. You're connecting them with experts around the country. And you're doing that in an affordable way by using a lot of analytics and data and technology in the background that not only connects them, but helps them do their due diligence. And I guess then building on top of that, you've got like the financing and the cash flow side of property investing and property buying. So this is interesting because I figure like it combines two things that Australians love and two things that investors love, which is property and technology, because you're marrying them together. So is the model that basically you source fantastic buyers agents, or who you think are like high quality buyers agents around the country, and they come to the platform because they're going to get served with leads. And on the consumer side, I'm going to go on the website and I'm going to put in my details and get matched with someone. Is that basically the platform side of it?
Yeah. So we built a national panel of 25 property buyers agencies. So it doesn't matter if you're buying in Sydney, Melbourne, Southeast Queensland, but also if you're buying in Perth or Adelaide, Canberra, regional Australia. We've got agencies that cover all of the main cities and main regional hubs. So that's the first thing. You're right. The tech is a big part of it, because for us to make this worthwhile, it's got to be fully scalable. We've got to be able to cope with thousands of transactions. We don't want to do it on a low volume. So we spent a lot of time building out tech. So everything's automated, screening, matching, invoicing, collection, you name it. I guess ultimately what we want to do is build an affiliation with one of the major lenders. So we're in process with that. So we're speaking and meeting with one of the majors. So I guess the key thing for us is that the whole thing has to work on a scalable basis. Another thing is that we acquired the IP of RiskWise into the company BuyersBuyers. So we've got actually a suite of property market reports, which can actually help people with that decision on where and what to buy next. So we've got regional economic analysis. We've got a report called Where to Buy. You just key in your key criteria, brings out a suburb shortlist and recommendations. So we've got a range of tech that sits alongside the traditional part of the industry, which is, as you said, connecting people with buyers agents and actually buying the property.
So it's when we were talking about this, I didn't realize the sophistication in the back end. So I thought that was pretty neat. And I guess that acquisition makes sense. And it gets you guys off the ground and building that platform far quicker than you could have if you just started from scratch.
Exactly.
Yeah. So you mentioned, because this is a really interesting part too, as a business owner, is you're trying to raise capital. You're trying to raise capital for the business to fund that next leg of growth. How have you gone about doing that? Like, who do you approach? How do you network? How do you get conversations with the right people?
Yeah. So I guess what we did a seed round, and that was what they used to call the 3 Fs or the 4 Fs, depending on who you speak to, mainly just connections, friends, false family. We picked up, I guess I've been in financial circles for most of my adult life. So you build up a decent range of connections over that time. We picked up 4 investors from Atlassian. So a couple of those guys sit on our IT board advisory, and they're just helping us to build the flywheel because they've been through that process before. One of the guys was the architect of Jira. So that they can help us to see the problems ahead of time.
Yeah, for sure.
For the seed round, it was mainly just personal connections, friends of friends, people who work in finance. 3 or 4 of them are fund managers in their own right, so professional investors. But I guess getting to the Series A round, we've raised 1 million from our own efforts, but we really now need to go on, look at family offices, VCs, fundies, or whoever, people with somewhat deeper pockets and investment expertise, just to take us on to that next level.
And you mentioned before that, like, I feel like a lot of the pitch is basically like, here's where we are now, here's our MVP, which you seem to be past that because you mentioned the run rate before. and then it's here's where we can get it to. You said before that only around 3% of people use a buyer's agent. How big can that get? You referenced the mortgage broking side, which is now about 70%. Is that what you think it gets to, or is it much lower than that? Like, where do you see that falling?
I think it's lower. For the market as it works currently, it's much lower. I think if you go to some parts of the States, for example, most people will use a buying agent, but it's a different model. That's where the commission is actually split from the sale of the property, and the buying agent gets paid that way. I think where there's actually a fee to pay, I mean, we've run models. If you have an affordable marketplace solution, in theory, it could be as high as 40% of the market. I think, I mean, in our estimation, if we can get the market up towards 5 to 10%, I mean, that's a huge addressable market in its own right, particularly if you've got the ancillary services that hang off it, the buying process, because you've got home loans, but then there's all the other stuff, building surveys, property management, depreciation schedules. So look, we're hoping to sort of grow the market towards 5 to 10% over the coming years, which I think with an affordable solution is eminently achievable. I think the game changer for us would be if we can package up a first home buyer option for one of the major lenders or one of the other lenders in Australia, whereby the cost can actually be wrapped up into the loan or absorbed by the lender, then obviously then that really does open up the market, because just like when you go and see a mortgage broker, you're not putting your hand into your pocket to pay a direct fee. So I think that would be the game changer that could really open up the market.
So you could effectively, you could go to BuyersBuyers and you're buying a house almost frictionless, and you guys are just facilitating that entire process, which makes a lot of sense. Yeah, right. Okay,
it's a win-win, right? Because it's a very inefficient industry, and only about 60% of mortgage pre-approvals ever become home loans, because so many people either give up in despair, they can't find a property, they find another deal elsewhere with another lender and they switch. And so there's all of those loans, pre-approvals actually lapsing and never converting. So it would be good for lenders. Buyers agents help people to buy with less time, less cost and less stress. So it would increase the conversion rate, but it would also de-risk the process, because they've got a systematic due diligence and experience to negotiate the best possible price and terms, and just avoid all of those pitfalls that you don't necessarily know about when you're buying your first property or any property.
I didn't know that it was 60% of those pre-approvals lapse. That's a very high rate. And like you said, that's incredibly inefficient. So I think that's a story that everyone can follow along with. If you follow Pete on Twitter or LinkedIn, or if you can just jump on the website, BuyersBuyers, you can follow along. And if you want to get in contact with Pete, be sure to reach out to him. Thanks for sharing that with us, because as someone who's an investor and also someone who's started a business from scratch, I know that it can be tough work, and there's a lot of, I guess, risks and pitfalls along the way. And it's interesting to hear how you might challenge those and solve those problems along the way. I think you've got a great co-founder there that kind of marries with your skill set really well. So that's fantastic. Now, I know there was a few questions that come through on Twitter for our conversation today, and they revolved mostly around asset classes, property, and interest rates. So I guess the first question is, are you concerned about rising interest rates? Maybe, and you can talk to this not just from property, but from any other asset class.
Well, yeah, it's the big story, I guess, at the moment. Inflation has taken off, not just in Australia, all around the world. UK, they're expecting double-digit inflation now, driven by food and energy prices. The US is at 8.5% inflation. New Zealand's not far behind. Australia's sort of 5 and heading to 6. So, yeah, for sure, inflation is a big issue for cost of living. And I guess the result of that is that we've had emergency interest rate settings now for a couple of years, but things will start to normalize. And I guess, yeah, that is a concern for households because it's a double whammy. Not only is the cost of living going up, but if the cost of your mortgage is going up as well, then that could be painful if people haven't been setting aside a buffer. So, yeah, for sure, that's the sort of number one issue in financial markets at the moment.
Yeah, I heard Warren Buffett say, Q&A recently that interest rates are to asset prices what gravity is to matter. And it's interesting because it affects all asset classes, right? At least those that don't benefit from rising interest rates. So maybe TDs or term deposits do, but that's, there aren't many that do. One of the questions that come through on Twitter is actually about the USD, the US dollar. And the question was more around, do you see it continuing to be the reserve currency? And I guess maybe if you do have an opinion on that, do you think that that's at risk, or do you see that we're still buying US dollars when rates and uncertainty and geopolitical concerns are high?
Yeah, I mean, I guess it's been part of the narrative, hasn't it, in recent years that the US dollar is going to be trash, and we're going to get new digital currencies will take over. I guess the interesting thing has been the sheer strength of the US dollar in recent times. It's kind of put those arguments to bed in my book. I guess to your point on Warren Buffett, I mean, I guess this is more your wheelhouse than mine, but what is the impact of rising inflation and interest rates on stocks? Because I guess the thing is, it probably comes down to your own philosophies, because you can probably find a study that will tell you, inflation is good for stocks, interest rates, because the S&P 500 is volatile, and therefore most stock markets follow around the world. I guess that my best understanding of it would be that probably value stocks are going to be less impacted. I think energy has had a great run, but maybe things like telcos and consumer staples, the traditional value stocks, but some of the growth stocks where you're looking at some of those discounted cash flow models, and it feels like in the last couple of years, it's been like an enormous bet on the long end of the curve. But if interest rates are going to start normalizing, and we've already seen it, right? Stocks like Netflix and Coinbase and Beyond Meat, and suddenly some of those valuations have just plunged. So yeah, look, I don't know the answer, but I guess you could make the argument that higher interest rates could equate to lower valuations across markets, but maybe some sectors will do better than others.
Yeah, because that's another question that came through, was basically how do certain asset classes perform in different inflationary or interest rate environments, and we'd have to go back quite a while to start to study these things. And I don't know if you think in a similar way, but I often find that people will reference things, say like the performance of stocks or the performance of a sector, or even property in certain markets. They'll go back to the late 90s, early 90s, 80s, 70s, wherever, and then they'll say, see, this happened, as if like we can expect that now.
Yeah.
One thing that we see, if we just zoom in on property actually just for a minute, because there's one question that I had prepared in advance, was if we zoom in on property, there's a lot of headlines like we saw this during COVID, property prices going to fall 32%, then they went the opposite direction. So what are some of the things, if people are scared about property in particular as an asset class with rising rates or inflation, what are some of the things that you might look at? We hear mortgage distress, all those types of things. Like, what would you primarily be looking at as an indicator there?
Yeah, I mean, it's basically rising interest rates. I would probably try and think in 10-year chunks and not what's going to happen in the next 6 months, and probably choose your information sources. The people who really follow markets closely, Cameron Kusher at REA, Tim Lawless, CoreLogic, Nerida Conisbee, Ray White. I mean, they're the people who are really across markets. Now, I know some people might say, oh, but they're the real estate sector. But there's people like Chris Joy, who's he's not going to be preternaturally bullish or bearish. He'll give you some informed opinion. But I think the main thing with property is you've got to think of it as a longer term investment, because the transaction costs are quite a clip. So it's not really going to work as a 1-year investment for people. So you need to be thinking 10 years out. And why is real estate traditionally seen as an inflation hedge? Well, I guess there's probably 4 ways that you can benefit. One is you fix your mortgage rate when interest rates are low. So when everyone else is being punished, you're sort of sheltered from it. Generally, you would expect to see rents going up 15-20% for houses this year. So that's another way. You're kind of almost exporting the inflation on to the tenant. Construction costs have absolutely rocketed over the past year. So I mean, that doesn't impact established housing directly, but it does to some extent underpin the cost of new dwellings coming onto the market. I mean, timber prices were up, 50%, steel was up 20%. So, the cost of constructing a home has gone up 20% plus over the past year. And I think the other thing is that generally, and this is more of a long-term thing, is that debt just, as an investor, gets inflated away over time. So, thinking back to, my wife's first property purchase in 1996, you look at the mortgage today and think that's just tiny, like when you look at it 25 years on. So, and I mentioned the UK with 10% inflation. Well, wages are starting to spiral now. So, in the short term, the interest rates could actually be punishing for the property market, but that is a high rate of inflation and effectively inflating away the debt over time.
That's a really interesting one. And I think that is an important point, because if you think about the long-term orientation, if you've got a short-term orientation with high frictional costs, you are going to probably lose in that respect. But if you do have that longer-term view, like you said, that actually can play into your favor in dramatically so. And we see that not just with residential debt or like consumer debt or whatever. We see it with we see it with central banks as well. That's kind of the theory, right? That higher inflation enough inflation can inflate away central bank debt. Do you see, there's a lot of talk about a soft landing, hard landing, so on and so forth for the economy. Do you think about that a lot? Do you think about like how we're going to handle that side of the ledger as well?
I think a soft landing might be difficult. I think the way inflation has been going, and the Fed's talking about 50 basis points next month and another 50 the month after. And when you start to see the pace of potential pace of interest rate increases, there's already a good potential that 2023 there could be a recession. I try not to worry about these things. I guess certainly from a real estate point of view, you just got to take a longer term view. I mean, we actually have had a recession in Australia through COVID, as you mentioned, but then the stabilizers kick in, interest rates start falling again, government tips in the fiscal stimulus, and things normalize themselves. I guess if typically recessions, they used to say happen every 7 or 8 years. So if you're going to invest for the long term, you're going to get some. So if you're an accumulator of assets, you're going to pick them up. I mean, it's an interesting point. I mean, you mentioned people say, well, what happened when inflation was high before? But it doesn't necessarily follow. In the 1970s, inflation peaked at 17.5%. And Sydney house prices did 250% over the decade, and units did 300. But it doesn't necessarily follow we're going to see the same thing now, because there's more debt around already. Prices are higher. So it's a bit the same with the CAPE ratio and stuff like that. People say, oh, well, look at 1880, the CAPE was da-da-da. So, but things have changed a bit over time. So I think sometimes you should be a bit wary about superimposing trends from yesteryear onto today. But I suppose another thing that people say, about market cycles, buy low, sell high. Look, I get it. But, just to take that example that I mentioned, my wife bought her first house 96, had 10 years of boom to 2006. And then 2007 to 9, there was a downturn. And it's easy in hindsight to say, well, why didn't you sell in 2006 and then buy again in 2010? But the reality is people were talking about a crash from about 2003, and then it boomed for another 4 years. So if you knew in advance, sure. But there's two things. There's the capital gains taxes, and can you actually time the market that easily? In my experience, not that easy.
Yeah, I see that. We see that on the other side of the fence, right? In stock market and equities. The people that are most fearful of investing and put it off when you're in a bull market are also the ones that tend to be most fearful when you're in the bear market and refuse to invest because they think it will fall further, and they never invest. So we see that psychology play out no matter where you look with money. There was one question that come through on Twitter. KCW Capital asked, or just maybe made a point, something for us to focus on, is if you have any commentary on both the potential demand spike and the supply side impacts of both policies from, I guess, the government in terms of what they're proposing in the election with stimulus for housing and for affordability and those types of things.
So different policies. The coalition has proposed, somewhat controversially, people using 50,000 or up to 40% of their super balance to buy a first property. Look, most young people don't have that much in their super, so it will be more beneficial to people in their 30s plus, especially couples. Are there enough first home buyers with that kind of money sitting in their super? It's questionable. It's obviously supportive, and it's a demand side measure, but I don't know that it's going to be market moving. I think as much as anything, what we've seen, this is something we talked about in Noosa, right? It's almost like a rebasing of expectations. If the government's going to keep stepping in every single time there's a hint of a downturn, as they did in COVID, what did we see? Mortgage holidays, term funding facility, just write a letter to the bank, say I'm not paying the mortgage for a year. All of these things are just resetting the expectations of the market because, again, we're talking about rising interest rates and Labor's in with a shared equity scheme. So I think, yes, it's a demand side measure, and the same for Labor's shared equity scheme. I don't think in themselves they're market moving, but maybe just from a psychology point of view, it's almost a statement that we're not going to let the market crash. So, Labor's sort of got a 10 billion affordable housing fund proposal, but I mean that when you break it down, that equates to 6,000 dwellings a year in a market of nearly 11 million dwellings. So it's a fraction of 1%. So again, it's not going to move the needle. There's not really much being done on the supply side, I guess, is the issue.
I think that's probably the bigger issue, more structural issue, right? You just talked about property price, construction prices going up. Like, it doesn't make it any easier. I think that's the conclusion, that after many years of back and forth, we spoke about this. It's just not a fair fight for most investors. You want to play where you've got support of the government, basically, and that's what we've seen. And I know we're going to talk about this on another show on your podcast coming up soon, talking about how you can use property and how it has utility outside of necessarily just like the price. So it's a fascinating thing. There is one final question which I might get in here, which is more of a cheeky one. My question for Pete is, will the property price in Brisbane start to fall next year?
It's funny, actually. About every third email I get, you get on Gmail, you get these sort of promotions, and every third or fourth email is why Brisbane will be immune to the downturn. But unless somebody's changed something, every market will cycle. The prices will cool off for sure. I guess people who are looking at Brisbane as a market, we mentioned the 10-year timeframes. Brisbane Olympics 2032. If you're thinking about buying in Brisbane, that should be a focus, 10 years plus, because of course there'll be a downturn, and we've just had even more flooding, which won't help. We had the floods 2011-12, which was, because the previous floods had been 1974, there was a lot of talk about it being a 1 in 50 year event. But then it was a 1 in 10 year event. Now it seems to be quarterly. So I think there'll be a downturn as interest rates rise, or at least a slowdown. But whether you can fine tune the market that easily. I guess the one thing that's really changed from, say, 2013, 14 is that there isn't a big overbuild now of units. There's a lot of units being built for Chinese investors before, but now there's a real shortage. And as you said, there's a shortage of tradies. Construction costs are going up. Aussies don't buy new units typically, except a few super funds. So the big challenge for the next few years is supply. Where is all the new supply going to come from as the borders reopen?
Yeah, good point. And that's a fitting way to maybe put a bow on this conversation, mate. It was great fun catching up last week and having a chat with Ben up there in Noosa as well, and also get you on the show today. So I'll put a link in the show note. Wealth Ways for the Young. It's holding up on the screen if you're watching. And people can find you on Twitter at Pete Wargent. You can head to BuyersBuyers.com.au. If you want to get in touch with Pete about your interest, express your interest in what he and Doron are building, please do that, because he's taking conversations around funding and wants to network and those types of things too. So Pete, mate, thanks for taking some time to join me on the show again.
Pleasure. You're better at capital raising conversations than I am, and well, I'll keep working on you to relocate up to the glorious Sunshine Coast at Noosa. So
yeah, I don't think it will take much convincing coming into winter here in Melbourne, mate. So yeah, mate. Once again, I appreciate it.
Pleasure. Thanks, Owen. Cheers.